No, sir, not clear. Sir, you are audible, but not clear.
Hello.
Now it's clear?
Yes, sir.
Okay, okay. So there is some, you can say, the network issue at my place. So okay, now it's okay?
Yes, sir. It's now
Okay. So,
बरोबर म्हणजे तू तिथं बोलला. यार काय बोलतात?
guys, please unmute yourself. Okay. So in last session, so we understand we finished the second chapter, that is the risk and return analysis. So what we understand in this last chapter, we'll take the brief of the second chapter, that is we understand first the different types of risk associated with the any investment. Okay, we understand the economic risk, we can say the political risks. Okay, so these are some types of risks we understand, which are, or we can say the credit risk, that is the default risk. So all these risks are always will be there with the, we can say the different investment avenues. Okay, so we understand the return. What is the return? Okay, the what the incomes we received by investing the funds or the amount of money into any investment avenue. Okay, so that income we called as the return. We also see the formula, that is the net income from the investments, or divided by the total investment into 100. If we do that, then we will get the return. So what is the relationship between risk and return? Okay, so that we also understand. That is, we see that the risk and return are the directly proportional, we can say, parameters. Okay, that means whenever the investor takes the higher risk, he will get the higher return. But there is always a chance in the high risk investment that investor may lose all his investment, all his funds. Okay, we can say some of the example, if you are taken, that gambling and the speculations are the, we can say, the high risk investment. Okay, the investor may get the high return, but there will be always a chance that he may lose all his investment, all his funds, all his money. Okay, so we can say this safer safest thing is the we can say actually the investment. So investments did by the investor, we can say we also understand the detailed process of the investments. Okay, that is the investment process. Okay, so investment process starts with the we can say the set of the objectives. Okay, at the starts of the investments, the investor always set the goal, what he wants in what time horizon, what is the funds he has, what the return he want. Okay, so after we can say some point of time, okay, how much funds he wants, okay, how much funds he wants to grow, uh, and what is his we can say the ambitions. Okay, what the investor want to purchase. Okay, so the investment process starts with this. We can say then he analyze the market, then he prepares the plan, then he execute the plan, and then he monitor and review the investments. Okay, so that we understand. Okay, so while doing all this investment process, that the investor must know that risk and returns are the things which are directly proportional with each other. That means whenever investors take the high risks, he may get the high return, but there is a we can say always the we can say the fear of loss all the funds and the money. But whenever he takes the less risk, okay, for example, uh, he invest his amount of money in the fixed deposit with the SBI. Okay, so we know that after the 5 years, he definitely gets the funds. Okay, the interest rates on which he we can say made that fixed deposits. Okay, so the risk associated with the such a type of investment is less, but the return also gets to the investments are we can say are less as compared to the we can say the other investment avenues like the futures, options, swaps, or we can say the share capital mutual funds. Okay, so these are the investment which we can say approximately gives the return to the investor more than the 12 to 13%. It may up to the 20 30%. But on bank fixed deposits, we know that the investor gets only the 7 to 8% interest rate. So this is how we understand the we can say the relationship between risks and return. Okay, so we also do the some type of analysis in we do the fundamental analysis. Okay, so that means before doing the investment, the investor has to we can say must do these two type of analysis. First one is the fundamental analysis, and second one is technical analysis. So, in fundamental analysis, as we discussed already that part in the yesterday's session, that in fundamental analysis, we understand the different financial statements. Okay, we the investors, what he did, he analyzed the financial information from the financial statements. Okay, or also that is we can say the this is the we can say he do the company analysis. In company analysis, what he do the we can say the financial statements analysis of that particular company, that particular organizations. Okay, so he before investing in any industry, the investor has to do the industry analysis. Is the industry is growing at the fast pace? What is the demand and supply in the particular industry? Okay, what is the GDP growth in that particular industry? Okay, what is the we can say the customer base of that particular industry? What is the income of the customer? What is the demand? So all these things we analyze in the industry analysis. Next part is we can say economic analysis. We also do in a fundamental analysis in that we analyze the we can say the different economical factors, that is the we can say the gross domestic product, gross national product, okay, net national product, employment, interest rates, inflations. So all these parameter always have the impact on businesses. So that's why in fundamental analysis we do the only the fundamental we approach while doing the analysis. So that's why we called as it's the fundamental analysis. So in technical analysis, what we do technical analysis, we can say it is actually a macro analysis. Okay, so whenever we actually in technical analysis, the investors find it out what are the trends and patterns of the financials of any particular organizations or company for over a period of time. Okay, so that the investors understands from the fundamental not fundamental but from the technical analysis. Okay, so in technical analysis what investor do he we can say prepared the different we can say the patterns, different charts, graphs, okay, line graphs, candlesticks. So all these are the examples of the technical analysis. So from this different graphical representation, the investors understands the pattern. Okay, I- if he finds that if there is any, say we can say, if he analyze the pattern for last we can say 15 years. Okay, so he automatically find that so the companies who are making the fans or the ACs, okay, so their shares prices gets increases in the uh, summer time. Okay, because of we know that automatically the sales at that times gets increases. Okay, so it may be one of the example of the we can say the pattern or the trends in any of the particular we can say of any particular company. So this part we do in the last sessions. Okay, so in this chapter third, the chapter third name is the valuation of bonds and shares. Okay, so that means the one of the investment avenue or the investment options is available to investor is the we can the share capital and the bond. That means the investors can invest in a share capital and the investors can invest in the bonds. So, what is the difference between the two different types of investments? Okay, the two different types of investment avenues we can say, and how their values calculated. Okay, how the valuations of the bonds and shares are done. Okay, so that part we are going to understand in this chapter. Okay, in this session, so that's we are going to understand. So before understanding the valuation of bonds and shares, first we need to understand the what is mean by shares and what is mean by bonds. Okay, so as we know that for the business purpose, the every organization wants the capital. Okay, so capital it may be we can say to start the business in the starting of the company. If we can say the company is the well established, then but the company is at the small scale, then for his expansion purpose the companies wants the funds. Okay, if the companies wants to grow internationally or we can say nationally across the all corner of the nation, then also they wants the funds for the expansion purpose. Okay, if they want to expand in a different sector, so in such a cases, the companies want the funds. So they have the two major options to raise the fund. That is, first one is the share capital, and next one is the bonds. So we understand first the share capital. Okay, uh, for examples, I am owning the company of near about the we can say the 50 CR, that is 50 crore company that I am owning. But I want the more funds to expand my business. So I have the two options. Either I can take the loan, or either I can we can say take the different partners in my business. Okay. So share capital is nothing but it is the we can say is the type of the partnership. That means if I take the funds from the 10 people, then I what I gave to the 10 people the ownership of my business. So in share capital, the same thing that we see whenever I buy the share capital of the any organization, that means I am the owner of that organization of the same percentage what the number of shares I purchase. That means if I possess the 10% shares of the Reliance Industry, that means I am the 10% owner of the Reliance group. Okay, so this is how the share capital works. Okay, so whenever any organization wants to raise the funds for the share capital, so what the company first need to do, they have to um, give all their financial statements applications to the we can say the share NSE or BSE on which stock exchange they want to list. Okay, to that stock exchange they give the applications. Then the stock exchange we can say verify all the documents, and the investment banks helps the companies and the organizations doing all these things. Okay, so investment banks help them to we can say calculate the value of the shares. Okay, and then the company, then we already I told you that is there are four types of capital. That is the authorized capital. Authorized capital is the capital. Then NSE or BSE authorize the organization to raise the funds up to that value of the capital. Okay, for example, if my 50 share company gives the application for the share capital, if the we can see the stock exchange authorize me to raise the 20 CR. That means my company can only raise the 20 CR from the share capital, not more than that. Okay, so 20 CR, 20 crore is the limit for me. But when this capital is authorized by the stock exchange, but now I want only the 15 CR. Okay, at that point of time. So I'm not going to issue, we can say, all the 20 CR shares in the market. So I issue only the 15 CR. So these are the issued capital. Okay, so when I issued the 15 CR shares into the market, only the we can see if we say the 12 CRs shares actually sold into the market, so that is we called as the subscribe capital. Okay, and from the 12 CR I only received the we can say the 10 CR up to date, so that is the paid up capital. So these four types of capital that I also told you in the some of the previous sessions. That so these are the four types of capital that we can say authorized, we can say by the NSE and BSE, and after the authorized capital. So these are the some of the sub we can say classifications of the share capital. Once the organizations issue the share capital in the share market, that means the company or the organization is ready to compromise their ownership. Okay, that means whenever the organization raise the fund through the share capital, so they have to transfer that percentage of share capital to the investors, that is the shareholders. Okay, so shareholders are not are the real owners of the organization. Okay, so because of they invest in the organizations, okay, in the hope of that is we can say the growth of the organizations. Okay, so whenever the investor invest in a share capital, so what he thought, he actually the investor invest in a share capital for two purposes. Okay, first purpose is we can say some of the investors actually invest for the purpose of the dividend. Okay, and some of the investors they also want dividend as well, and they also want whenever they know that whenever company grows, their investment grows with the same percentage. Okay, so these are the two motives for the investment of the shares. So this is nothing but the shares. So we are going to understand how once the investor invests in a share capital, how its value determined at a different point of time. So that we are going to understand from this, we can say the shares. Now next one is the bond. So what is mean by bond first? Okay, we see the two options the every organization has to raise the funds. First we see that is share capital, and next one is the bond. That means if my 50 share company raise the 20 share from the share capital, but I want, we can say the another 30 CR. That means total I want 100 CR to expand my business. Okay. So, but I don't want to compromise the ownership further. Okay, because I know that if I, we can say compromise the, we can say the ownership above 51%, then automatically my ownership in the organization or the company may lost. Okay, so in a such a conditions, I don't want to, so as the fear of losing the ownership of the company, ownership of the organizations, the companies can say issue a share at this certain limit, at this certain percentage. But further, they want the funds for the expansion purpose. Okay, so they have the options of the bond. That means they can raise the funds through loan. Okay, so that means these are the two main, you can say investment options that each and every organization has. That is first one is the share capital, so they can raise the capital through share market by selling the shares of the organizations to the investor. We can say with that they do the we can say ownership transfer, the same percentage ownership transfer to the investors. Okay. So this is share capital, and next type of investments which is available to the companies, to the organization is the bonds. That means they can take the loans through banks, big banks, or we can say through the financial institutions or through the investment banks. Okay, so these are we can say they we can say issue a bond at the face value. That means I can issue if I want the 35 CR, then I issue the that is my organization, my company issued the 33 CR face value bond. Okay, and I issued that bond in the open market. Okay, so that bond is actually sold on the discounted value. Okay, so the bond is actually sold on the price of 30 CR and my company received the 30 CR value. But we can say on the maturity of the bonds that I will have to pay the 33 CR. Okay, so that is 33 minus 30, that 3 CR, that is the 3 crore is the profit of that we can say bank or the financial institution who provides the loans to me, or we can say any individual in we can say investor who has that 33 CR amount can purchase the bond of my company, and then after the maturity he can we can say enjoy the return of 3 CR. Okay, after the maturity he gets the return of 3 we can say crore. Okay, so this is how the bond works. Okay, so now the basic difference between share capital and bonds. So what I assume that you can now understand. So bond is nothing but a loan, and share we can say the shares are we can say these are the shares are actually the owners, actual owners of the organizations. Okay, so we also understand what is the basic difference between the we can say if the company is not doing well. Okay, if the company we can say fails in the business. Okay, so what is the repayment systems in the shares and repayment systems in the bond? Okay, so if I may say I am having the 50 CR, I will take the example of that I am having any business. Okay, for example, if I say the business is, for example, if I say the business of, I have the business of, for example, the uh, any example we can say for we I have the business of the hotel industry. Okay, uh, so that my investment is a 50 CR and I raise the funds of 20 CR from the different shareholders. So that 70 CR. So all the investors, okay, who invest that 70 CR, including me, are the real owners of the organization if the business fails. Okay, so this owner has to bear the losses. Okay, that means if the we can say the company grows at a good rate, we can say the owners enjoy the we can say the wealth of the organization. As the same, the owner has to bear the losses. That means whenever the company liquidates or the company wind up, okay, so the we can say the loan first the organization has to pay the loans. Okay, so they have to pay the interest, they have to pay the loans because the loan giver is not real owner of the owner of the organizations or the company. So he first gets the payments of his loan, and then the other owners has to bear the losses. Okay, but if the companies grow at the good, we can say at the good rate. Okay, so who the any bank or the financial institution who gives the loan, they only gets the their interest rates and the we can say the repayment of the loan. Okay, so he will not get any extra amount, but in we can say the owners of the organization enjoys the wealth maximization, they enjoys the uh, dividend. Okay, so this is how these are the basic difference between the we can say shares and the bonds. Okay, so how its value we can say derived, that we are going to understand in this chapter. Now you I hope that you guys understand what is the equity share capital and what are the different bonds. Now we can say while doing the valuations, why valuation matters, that is the we can say first we are going to understand that valuation provides the foundation for making the informed investment decisions, comparing opportunities and building the diversified portfolios that match your risk tolerance. Okay, so what that valuation is needed, because if you do the valuations, then we actually know the what return that I'll receive on that investment. That is the investments in the shares and investment in the bond. If we find that the return is not that much that desired return, okay, so we can compare the share capital return or the bond returns with the other different we can say investment opportunities. Okay, and if we find that this we will receive the good return in the share capital. So okay, so we continue with the same investment. But if we find that we are receiving the less return, so we diversify the investment into the other investment avenues which are available to the investors. Okay, so here's the point, that building the diversified portfolio. Okay, also we can say if you find that if we give the loans to such a company that it may there is the default risk associated with that we can say investment. Okay, so it is the we can say the high risk high return investment. So in such a conditions, we analyze the risk tolerance of the investors. Okay, the emotional risk tolerance, we see the two types of risk tolerance, that is the emotional or psychological risk tolerance and the financial risk tolerance. Okay, so that is why the valuations of the shares capital and the bond is matters. Next one is the these are the two main asset classes, that is the bond is the, we can say the loan instrument or the debt instrument, and the shares are the equity ownership instrument. That means if you purchase the shares, automatically you get the ownership of that particular organizations. That represents fundamentally the different investment approaches with the distinct valuations methodology. Okay, so the valuations, because we know these are the two different types of investment. In one, you get the ownership. In second, you will not get the ownership. You will get the interest and repayment of your loan on the investments. Okay, so these two different types of investment. So that's why the valuations of these two different, we can say types of investments are different. Okay, so we can say we in today's scenario, if we understand that is we can say the bond valuation that examine the bond risks and we can say master equity valuation models to build the complete investment toolkit. Okay, so what is the bond valuations? Now we understand what is the bond. Okay, bond is nothing but the loan. It is the type of instrument of physical on physical paper that all the terms, conditions, value of the loan, interest of the loan, type of repayment, type of reason, so all that things is included in the we can say in the bond. Okay, in the paper of bond, and we can say the organization, the company who issues the bond, the company transfer that bond certificates to the investor who are going to provide the loans to that particular company. If it is a bank, then company transfer that we can say that bond, okay, in which all the parameters are clearly mentioned. That is the loan amount, interest rates, okay, so time of repayment. So all these things which mention in the bond that transfer company to the bank, and then bank transfer the funds, that is the loan to that particular company. Okay, so that is the we can see the procedure of the we can say the bond. So how the value of the bond derive, that we are going to understand. So bond valuation is the analytical technique used to determine the theoretical fair value of the bond. Okay, actually we can say we know that we can say as I told you that if there is the manipulatory some factors which active in the market that may affect the intrinsic value of the any instrument. That is the intrinsic value of the shares, intrinsic value of the bonds. So in that bond valuation, actually we determine the theoretical fair value based upon the following points. Which are the following points? That is the present value of all the future cash flows the bonds will generate. Okay. First, we calculate the present value. Okay, we know that on bond, the companies continuously repay the EMIs. That is the we can say the monthly investment, monthly installment. Sorry, monthly installment. The company is going to pay to that bank. Okay, that means the interest plus the we can say the value from the loan. Okay, so the summation of that is the summation of all this the companies pay to the whoever the entity who provides the loan to the companies. It may be a bank, it may be the individual investor, it may be financial institutions. So we can say the monthly installments are paid by the companies to the loan giver. Okay, so as we know, that is the so all these are the future cash flows. Okay, if I take the 30 CR loan from the banks, uh, uh, as we take the example that mine company is the 40 CR, I raised the 20 CR from the share capital, then I also needed the extra 30 CR. So I we can say take the loan from the banks that is on the 30 30 CR loan from the bank. So in bonds, we decide all the things. That is the loan amount. Now it is the 30 CR. Okay. So now we also decide the interest rate, the time of repayment. If I say it's the, we can say the 10 year, then my company have to pay the monthly installments to the banks. Okay. So all these are the future cash flows. So what we assume today that my company is going to pay the some we can say amount of rupees monthly to the that banks, particular banks who provides the loan. So all these are the future cash flows. Okay, so you know that is you guys understand the concept of the present value, future value in the chapter of we can say the time value of money. we know the value of money is different at the different times. Okay, so the purchasing power of the money gets decreases over a period of time. So that is the concept of behind the time value of money. Because we know that some of the factors, that is the inflation, we can say interest rates. So all these factors reduces the value of the money over a period of time. That means what I am going to purchase today, the purchasing power of money gets decreases over a period of time. That means, for example, in 110 years, today I can purchase a 1 liter of petrol, but it is not the case after the 5 years. It may be the case that after the 5 years, I have to pay 200 rupees for the 1 liter of petrol. That means the work of 110 rupees after 5 years will be done by the 200 rupees. That means the purchasing power of the money gets decreases over a period of time. In we can say in the so actually we in bond valuations we calculate the present value of all the future cash flows. So there is the we can say one formula to calculate we can say the future value. So future values formula is equal to P, that is the present value 1 plus R raised to power n. So we can say R is nothing but the we can say the rate at which the money is it is actually the inflation rate we can say. So the rate at which the we can say the values the inflations the value of the money gets we can say decreases, that is we can say the R. So F is equal to P plus 1 raised to power n is the formula for future value. So if you know the present values formula, then if we can say uh, adjust the formula, then we will get the present value formula. So present value formula is equal to F divided by 1 plus R raised to power n, because the 1 plus R raised to power n, we transfer this we can say bracket into the another side of the formula. So so that's why we transfer on the another side in the denominator. So that is the basic mathematical rule. So by using that formula, we calculate the present value of all the future cash flow. Okay. So next one is both the coupon payments and the return of the face value at the maturity. Okay. The we can see the repayment in the bond markets. Um, we can say by do by the two methods. That is the monthly EMIs as well as the we can say the lump sum amount at the maturity of that bond. Okay, so we both we can say both coupon payments and the return of the face value. That means after the 10 years, up to the 10 years, so I'll pay the monthly installments to the banks, and also after the 10 years, I'll pay the some lump sum amount to the banks for the 30 crore that I raised from the bank. Okay, so we calculate the present values for all the future cash flows, okay, for the monthly installments and for the lump sum amount that my company is going to pay after the 10. Okay, so we calculate for both that is for the monthly installment payments, that is the coupon payments. So there is also one other word for the monthly installment, that is the um, coupon payments. So in finance we called it as the coupon payments, and also at the maturity we pay the maturity we can say amount. That is we can say the lump sum amount of the loan after the maturity. So for all both of these types of payments, we calculate the present value, and then discounting using the appropriate yield that reflect the risk and return conditions. I already told you the some of the bonds, the debentures are issued in the market on the discounted value. For example, if I want a 30 CR, I have to issue the face value of bond debentures in the market of the 33. Okay, so we calculate with the 33 CR's present value uh, according to the rate of return, that is R. Okay, if I find that the present value is the 23 CR, okay, and 29 CR, and I gave the loan of the 30 CR. So my organization, my company is in a profit. But I'm going to pay the 33 CR after the 10 years, and I calculate if the present value of the that 33 CR is 31 CR. Okay, so automatically my organization is getting the 1 CR less from that debenture. So this is the things. Then this is how we can say calculate the value of the bonds. So we can say what are the key features of the bond. First, features is the face value or the par value. We can say that means the principal amount that will be returned at the maturity typically. Uh, okay, the example which I given to you guys, that the principal amount that return at the maturity. For example, if I take that the my company requires the 30 CR, but I issue the debentures or the bond in the market is of the 33 CR. That means I get the loans of 30 CR only. Okay, but the face value of my bond is of 33 CR. That means after the 10 years, after the maturity, my company has to pay the 33 CR amount to the uh, issuer of the loans, okay, to the banks, we can say to the financial institutions. So this is the face value, okay. So next one is the coupon rate, that is the fixed interest rate paid periodically. If we can say in the bond, the company or the organizations uh, or the financial institution who provides the loan, they mutually decide that fixed interest rates. On that interest rates, the company is going to repay the loans. So the fixed interest rates paid periodically, usually semi-annually. Okay, so whatever it may be, the interest rates they mutually decide, that we call as the coupon rate. Okay, so it is the another name of the interest rates actually. So next one is the maturity date. Okay, okay, we know that for each and every loan there is some time limit. Okay, if you take the loan for to purchase the home, that is the home loan. Same likewise, we know that you see in your family, the some of the persons are we can say get the home loans, but there is always a time limit. That is the we can say the 20 years, 25 years, or 30 years. Okay, so there is always a time limit associated with the loans. So the date when the principal, that is the face value, is repaid to the bondholder ending at the bond contract. Okay. For example, we take the example that is we issue the bond is of the 33 face value, 33 CRs face value, okay, in the market, and we decide the maturity date of the 10 years. That means uh, the 10 years uh, is my maturity. So after if the bonds mature, so on the date of maturity, my company has to pay the 33 CRs face value to the issuer of the loan, that is the bond holder, okay, who holds the bond. The one whom we can say gave that bond at the start of that we can say contracts. Now next one is the market price. So the we also calculate the current trading price, which may be at the discount, the below par, at par, at the premium, over depending upon the interest rates. So in some of the cases that the bond may transfer to, that means you know the concept of the loan transfer. Okay, so this is how. So while we can see whenever the bond transfer from one investor to another, or whenever the loan transfer from the one bank to another bank. So at that point of time, we need to calculate the market price of that loan of that bond. So this is that concept. Okay. So So what are the different types of bond actually? So that we are going to understand. First one is the coupon bonds. Okay. So the coupon bonds that provide the, we can say, the periodic interest coupons throughout the bond's lives plus the return at the principal at the maturity. Okay, so these coupon bonds, so actually they provide, they pay the monthly installments. Or okay, they pay the coupons. Okay, so whatever the, we can say, the company and the banks mutually decides. Okay, whatever the company, or we can say if the financial institution is the another party or individual investor is the another party, what they mutually decides. If they decides the mutual monthly installments, or they we can say decides the quarterly installments, 6 monthly, yearly, whatever it may be. Okay, so the coupon bonds is actually the, we can say, the installments type of loan repayment, and after the maturity, they decide what principal amounts the company has to repay. So these are the coupon bonds actually. Okay, so next type is the zero coupon bonds. Okay, this in zero coupon bonds, there is a no monthly installments. Uh, Okay, while the repayment, the loans, the company only pays at the end of the, we can say, the maturity date. At the end of the maturity, they pay the face value. Okay, so face value to the banks or the investor who, we can say, they provide the loans. Uh, the actually zero coupon bonds is actually sold at a deep discount to face value and provide the, we can say, no periodic interest, the face value at the maturity. That means uh, that my company is required the 30 CRs value loan. So I have the two options while taking the loan from the banks. That is, I have the coupon bond options and the zero coupon bond options. That means if I take the loan on only the, we can say, the coupon uh, type, on the coupon, we can say, bonds. That means we mutually decide the interest rates, and my company is monthly paying the installments to that bank, and after the maturity, some amount, lump sum amount, I repay, and my loan is cleared. Okay, so second type is the zero coupon bond. That means if I require the 30 CR loan, then I issue the the bond is of the face value of the 33 CR. Okay, and I will not pay any monthly installments to the banks. Okay, at the end of the 10 years, at the end of the maturity, I only pay the face value, that is 33 CR, to that bank, particular individual investor. Okay, so these are the two types of bank, and next one is, we can say the co-level bonds. So these co-level bonds includes the provision allowing the issuer to redeem them early if the interest rate falls, or we can say the limiting appreciations. Okay, so that means that bonds, that is the co-level bonds that provide the facility to the investors. Okay, if they found that there is, we can say, the risks associated with my investment. Okay, we can say the interest rates are going down because of the reduction of the repo rate of the RBI. Then in that case, they can ask the funds early to the companies. Okay, so this type of bond is, we can say, uh, has a provision that the investors can, we can say, redeem their bonds, uh, we can say, before the maturity date. So that type of bond is the, we can say, the callable bonds, that is the early redemption notice. So the banks can send a notice to the company that we want that our funds, our loans back. Okay, we want our the funds back because of the interest rates are going down. Okay, so the banks think that now the loan is not that much worthy, so that's why they may redeem early. So these are the callable bonds. Okay, so how bond prices moves, that is according to the interest rates. If the interest rate rises, what is the impact on the prices of the bonds? If the interest rate falls, what are the impact on the price of the bond. So whenever the market interest rates increases, the existing bonds with the lower fixed coupon rates become the less attractive to investors, causing their prices to fall. Okay, so whenever there is a rise in the interest rates, we can say the uh, the existing bonds, okay, uh, becomes less attractive because the investor has the option to invest in the, we can say, in the other investment avenues on the high interest rates, because they at the start of the loan, they decides the interest rates mutually. Okay, at that point of time the interest rates are less, but now the interest rates are now rises. Okay, so in the open market now investors can get the more return. Okay, so that's why whenever the interest rates in the we can see economy increases, the existing bonds are the less attractive. Okay, we can say because of the lower fixed coupon rates. Okay, so whenever the interest rate falls, we can say the market interest rates falls or decreases, the existing bonds with the higher fixed coupon rates become the more attractive to investor, causing the prices to rise. Okay, if we at the start of the loan they decides the we take the example that at the time of the start of the bond, they decides the rate of the 6%, but now the interest rates in the open market are the 4%. That means we are receiving the 2% more from that bond. So that's why whenever the interest rate falls, the existing coupon rate has the higher fixed coupon rate are become the more attractive. Here is one example that a bond with the 8% coupon rate, when market rates are 6%, will trade at the premium, because of which the coupon payments are the more attractive. Okay, automatically we see the 2% difference in that example. Okay, so this is that is the impact of the interest rates. Okay, so that bond valuation formula we are going to discuss in the next sessions, and also we are going to understand how the shares capital valuations were done. So these two parts we are going to understand in the next session. So up to that point, if you have any questions, you can ask. We have the 1 minute, so you can ask if you have any query. Or otherwise you can leave and join the another session. So it's already 7. If you don't have any questions, anyone have any questions, or you can leave the sessions and you can join the other session. Thank you, thank you.